Before we hear from Senator Katie Britt, it's important to understand the stakes behind this exchange. This hearing centers on how U.S. bank regulators are revising oversight rules in the aftermath of recent financial instability, including lessons drawn from the collapse of Silicon Valley Bank. At issue is whether existing regulatory tools are too rigid, too slow, or misaligned with the real risks banks pose to the financial system. Tonight's discussion isn't just technical. It's about accountability, economic growth, and how regulators balance safety with innovation.
Senator Britt.
Thank you, Mr. Chairman. Thank you all for being here. Certainly appreciate what you're doing to restore accountability and credibility to the agencies that you lead. I'm going to start with Mr. Hill and Mr. Gould. I know that your agencies are conducting rulemaking to revise the flawed MRA process. I obviously wrote a letter, and I appreciate your attention to this. I think when we look back, we've heard a lot today about SVB, what could have happened. We know there were over 35 outstanding MRAs in that case. We need to make sure that when we do this, that it matters, and it's something that people respond to. So I appreciate your efforts, and I wanted to see, do you have any kind of update for me on that?
Sure. So the comment period closed at the end of December. We have been working to go through the comments. We've been engaged with the OCC on moving forward with the final rule. Meanwhile, we have been doing a lot internally at the FDIC. We did begin a process to start going through all of our outstanding, we currently call them matters requiring board attention and other supervisory recommendations, to begin the process of closing out those that don't align with the new approach. That's going to be a bit of an iterative process as we move to a final rule, but that process is underway. And meanwhile, we are working on starting to roll out training for our examiners to make sure that the full workforce understands the new approach and that it's being applied consistently across the board.
Okay, thank you, Mr. Gould.
A similar approach and status at the OCC.
Okay, excellent. I'm going to stay with you all, and I'm going to add Mr. Hopman as well. You were all involved in 2155 and the narrowly tailoring that was necessary to allow financial institutions to continue to grow and expand, and make sure that we are properly placing regulations and not just looking at size as such.
Before we hear from Senator Katie Britt, it's important to understand the stakes behind this exchange. This hearing centers on how U.S. bank regulators are revising oversight rules in the aftermath of recent financial instability, including lessons drawn from the collapse of Silicon Valley Bank. At issue is whether existing regulatory tools are too rigid, too slow, or misaligned with the real risks banks pose to the financial system. Tonight's discussion isn't just technical. It's about accountability, economic growth, and how regulators balance safety with innovation.
Some type of blunt force object, but rather, looking at this and making sure that we're creating an opportunity for growth and thriving. And I guess my question to you all is that, would you say that a bank, maybe $100 billion bank, you're looking at all the different sizes, or we'll just even say $1 billion bank should be treated differently than a $700 billion bank?
Size is certainly an issue, but as an insurer, I can tell you, we definitely don't want them to be similar. As an insurer, you want very different business models.
Excellent.
Yes.
Okay, great. Mr. Hill?
Certainly.
Excellent. As you know, we continue to see these banks grow and evolve, and we want to make sure that we modernize these regulations so that they include, they don't have these static thresholds that we're seeing. Senator Cruz and I actually just introduced a bill on that to index the $10 billion threshold in the Durbin Amendment so that institutions that were never intended to be subject to that rule are not subject to that rule. So I hope that we look at these outdated thresholds and we make sure that they make sense in today's current environment. I think I heard you talk about prudential standards, Chair Scott, and so I definitely agree with that as well. In addition to indexing, risk weights, also incredibly important to calibrate. I hope you're considering all of this with your Basel III rulemaking. And Vice Chair Bowman, you and I have had conversations about this. As we continue, though, to discuss affordability and home ownership, I heard you talking with Senator Senator Tillis about the mortgage rate, risk, weight. And so that is something that you all have taken into consideration as you've made this Basel III more palatable and a way that we can actually absorb it.
Yes.
Okay. Also, have you taken a look at hedging cost for farmers and what that happens with the agriculture community as a result of the previous administration? We heard a lot about the negative impacts that would have. Have you taken that into account?
Senator Britt, I share your concerns about the agriculture community and their feedback on the previous proposals. And yes, we have taken that feedback into consideration.
Wonderful. And among other troubling provisions in the last administration's Basel proposal that would have reduced credit capacity around, I think, about $150 billion per year and negatively impacted GDP growth. Are you all, as you revise this rule, fully considering the broader economic impact, including the price of credit and anything with regards to GDP?
Yes, you'll see when the proposal is published that we have an extensive economic analysis that's included with the proposal.
Okay. Everybody? Yeah. Thank you. Appreciate it.
What this hearing ultimately shows is how deeply interconnected regulation, economic growth, and financial stability really are. From updating outdated asset thresholds to revisiting global standards like Basel III, lawmakers and regulators are signaling a shift toward more flexible, but still cautious oversight. Whether these changes prevent future crises or introduce new risks remains an open question. What's clear is that these decisions will affect credit availability, housing affordability, and the broader economy. What's your take? Are these reforms overdue or too risky? Share your thoughts below, and if you value fact-based, balanced analysis like this, don't forget to like, comment, share, and subscribe for more informed breakdowns of the stories shaping public policy.